Canadians are increasingly drawn to variable mortgage rates. The appeal lies in the potential for lower interest costs compared to fixed-rate mortgages. Variable rates often start lower than their fixed counterparts, translating into significant savings. The current economic climate further fuels this preference for variable rates. Uncertainty dominates the global landscape, making future interest rate movements unpredictable. In times of economic turbulence, central banks often lower interest rates to stimulate growth. This potential for rate cuts makes variable rates an attractive option. Borrowers bet on the possibility of benefiting from these cuts. The fear of missing out on potential savings contributes to the popularity of variable rates. Home buyers witness others benefiting from lower monthly payments. The desire to secure the same advantage drives their decision-making. While the potential for savings is enticing, homeowners must carefully weigh the risks against the rewards. Variable mortgage rates, while potentially rewarding, are not without risks. The most significant risk is the unpredictable nature of interest rate fluctuations. Unlike fixed rates, variable rates can rise or fall based on market conditions. One of the primary drivers of interest rate changes is inflation. When inflation rises, central banks typically respond by increasing interest rates. For variable rate mortgage holders, this translates into higher borrowing costs. As their mortgage rates adjust upwards, so do their monthly payments. The Bank of Canada's benchmark interest rate plays a pivotal role in determining variable mortgage rates. When the Bank of Canada raises its rate, lenders typically follow suit, increasing their prime rates. To mitigate the risks, borrowers should consider stress testing their finances. A common misconception is that variable mortgage rates outperform fixed rates long term. This belief often stems from studies suggesting lower overall interest costs with variable rates. These studies are based on historical data, which is not a guarantee of future performance. The mortgage market is influenced by a multitude of factors that can shift over time. Relying solely on past trends to predict future outcomes can be misleading. Interest rate movements can be erratic and influenced by unforeseen events. The models used in these studies may not accurately reflect real-world market dynamics. Borrowers with shorter investment horizons might find themselves disadvantaged if rates rise significantly. It is essential to consider one's individual investment goals and risk tolerance. Choosing between a variable and fixed mortgage rate is a significant financial decision. There is no one-size-fits-all answer, as the optimal choice depends on individual circumstances. Variable rates offer the potential for lower interest costs and savings. However, variable rates come with the inherent risk of fluctuating payments. Fixed rates provide stability and predictability with consistent monthly payments. This can provide peace of mind, especially for those who value budgeting certainty. However, fixed rates often come with higher initial interest rates. Borrowers might miss out on potential savings if interest rates fall. The best approach is to consult with a qualified mortgage professional. By having an open and honest conversation with a mortgage expert, borrowers can make informed decisions. I also hold a L2 mortgage license and would be happy to answer your questions. I provide my clients a one-stop solutions for their home buying and financing needs. You can reach me at 905-962-9535. Don't forget to like, subscribe, and share. Thanks.